I'm Ryan Lightfoot-Brown of FundCalibre. We're joined today by the elite-rated Dan Roberts, manager of the Fidelity Global Dividend Fund. Thanks for joining us, Dan.
Thanks for having me.
Now, when we met you just before Christmas, you were of the opinion we were quite late in the economic cycle, but not quite ready for a recession yet. Is that still your opinion, or have you changed your mind since?
Well, the first thing I'd say is we're not really in the business of predicting recessions. I guess probably the observation I shared with you that this is an economic expansion which is very long in the tooth. It's one of the longest running bull markets, equity bull markets at least in history. But that doesn't really influence what we're doing within the fund itself. If I was to look at any aggregate metrics and share them with you, it would be based around things like corporate profitability or the level of debt companies have on their balance sheets or valuations across the wider market. We think those kind of metrics will give you a much better steer for the risk reward to us as equity investors than trying to predict, GDP, interest rates, FX, etc., which is famously difficult thing to do.
And your fund is currently invested in sort of the leading economies, UK, Europe, US. We're hearing increasingly about Japan and the growing income streams coming out of there. Is that an area you're seeing more ideas coming through?
Short answer is yes. I mean, we're very keen on Japan. I think if you look at the region, valuations now are at a discount to other developed markets, and it's the first time for a while we've been able to say that, first time for many decades. Fundamentally, the businesses are making progress. There are good businesses to invest in there as well. And balance sheets are very strong. If you look at the broader market, roughly half of the Japanese corporates have net cash on their balance sheet, so no debt to speak of at all. So those are attractions, of course. And then corporate governance is kind of the icing on the cake at the moment. It's improving. And that's coming through in the form of better dividend or more shareholder-friendly kind of actions from executive suites, better dividend payouts, more share buybacks, unwinding of cross-shareholdings, those kind of things. So that's a tailwind for the market as well.
But interestingly, you don't have any emerging markets, or not much emerging markets in there. Why is the weighting so low in emerging markets in Asia?
Yeah, so I would say the best thing to do there is to focus on where the fund gets its revenues from, rather than where the companies we invest in are domiciled. So if you pick up the fact sheet, you'll see roughly 5% of the fund comes from emerging markets. But if you look at the revenue base of the companies we own, it's over a quarter of the fund. So I would say we do have some pretty good exposure to emerging markets. It just tends to be through stocks which are domiciled in developed markets and which sell their wares into those emerging markets.
Now, earlier on in your career, you were a UK equity income investor. Why the decision to go into a global fund?
Well, the simple answer is I think it's a better product. More stocks to choose from is the simple observation to make. There's probably 200 or 300 stocks in the UK market. A large cap investor can choose from 10 times as many within the global market, and that enables you to do two things. It enables you to add more value within a sector. So I'm not just picking between two pharmaceutical stocks, Glaxo and Astra. I've got 24 pharmaceutical stocks to choose from. But also it gives you access to sectors which may be underrepresented or even not represented at all within a local index. So I guess tech is probably a good example for a UK investor. Only really a couple of stocks in the UK you can invest in the tech space, whereas clearly globally the US and Asia provide an abundance of that kind of exposure. So all in all, much better balanced portfolio and much better spread of risk across the portfolio as well, so a better product.
Now, the fund made a positive return in 2018, which is impressive considering the backdrop in markets. Why do you think it is that your fund held up so well?
I think there's a couple of things we can point towards. First of all, we look for valuation support in any stock we own in the portfolio. And secondly, we look for the kinds of companies which can prove to be resilient under a variety of economic scenarios, even more difficult economic scenarios. And if you think about what happened last year, there was quite significant valuation contraction in the market as interest rates rose, so our valuation discipline would have helped. But perhaps more importantly, identifying those companies that can make progress in more difficult times helped us when people were starting to worry about economic growth. So we had some good stock selection from the likes of Procter & Gamble, which you would have heard of. Wolters Kluwer has been a stock we've owned in the fund for a long time. Some good sector allocation in pharmaceuticals. But perhaps just as importantly, it was what we didn't own. We didn't own some of the stocks which drew down quite significantly across the broader market.
Dan, that's brilliant. Thank you very much for joining us.
Thank you.
And for more information on the Fidelity Global Dividend Funds, please visit fundcalibre.com.